Bismillahirrahmanirrahim. Assalamu alaikum and hi. This is your channel, The Perfectionist, where we will be discussing about business. In the previous sessions, we were discussing about the principles of accounting. In the previous session, we have covered about the financial statements. We also got a quick review of the things we have covered and also review questions. So now in this session we'll be covering about business transactions, analysis and recording. So mirroring business transactions. For once we have determined that a transaction has actually occurred, so we must decide means when the transaction occurred, the recognition issue, what value to place on the transaction, the valuation issue, and how to categorize components of the transaction, the classification issue. So, measuring business transaction, recognition, valuation, and classification. These three measurement issues must be resolved before a business transaction is recorded. Recognition issue basically involve when should the transaction to be recorded, while the valuation is concerned with what dollar amount should be recorded, and the classification issue deals with which accounts are affected. These issues underlie almost every major decision in financial accounting. So, the recognition is concerned with the recording of transactions. It refers to the difficulty of deciding when a business transaction actually occurred. Point of recognition is most important because it affects the financial statements. For example, the sale and purchase of a product. Usually recognized when a title to merchandise is passed from the supplier to the purchaser and create an obligation to pay. Next, valuation. Valuation focuses on assigning a monetary value to the transaction. Practice of recording transaction at low cost follows the cost principle. In the cost principle, we discussed that a purchased asset should be recorded at its actual cost. So, what is cost? Cost is exchange price associated with a business transaction at the point of recognition, whereas exchange price is an amount a buyer is willing to pay and a seller is willing to receive. The cost or exchange price is used because it is verifiable. The valuation is followed by the generally accepted accounting principles that we have discussed in a previous session. GAAP requires that all business transactions should be valued at a fair value when they occur. Classification. Classification is the process of assigning transaction to the appropriate account. The transaction must be classified according to the appropriate categories or accounts. So, moving forward to double entry system. Before moving forward to double entry system, let's discuss the accounts first. So, the record that are kept for individual assets, liability, equity, expenses, or revenues, or dividend components are known as accounts. For example, a business would maintain account for cash, separate for inventory, and for any other financial statement element. As you can see in the diagram, this is the account for cash for any respective company. So, You notice that the column headings for this illustrative cash account included increase and decrease labels. In actually, this label would instead be debit and credit. The reason for this distinction will become apparent in the following discussion. Accounts are basic storage units for accounting data. They are used to accumulate amount for similar transactions. As I have previously discussed in the slide, that there are different accounts may be separated for assets, liabilities, and components of stockholder equity that may include revenues and expenses. Debit and credits. So, before discussing the double entry system, it is obligatory for us to have a know-how about the debit and credit, which are abbreviated as DR or CR. They are unique accounting tools to describe the change in particular accounts that is necessitated by a transaction. In other words, instead of saying that cash is increase or decrease, it is said that cash is debited or credited. This method is again traced to Sully, the Franciscan monk who is given credit for the development of our enduring accounting model. So, for every transaction can be described in debit and credit form. For every transaction, debits must equal credits. So, before that, we need to discuss that there is a plus-minus system, but this lacks consistency. So, instead of this, we use debit and credit. So, why we use debit and credit instead of plus and minus? Following assumptions can be made: plus plus, minus minus, minus plus, plus minus. So, what if there is plus plus? So it means that services are provided to the customer for cash. So both cash and revenue would increase, resulting in plus plus outcomes. Whereas, if we discuss the minus minus outcome, so it means that paying an account payable causes a decrease in cash and decrease in account payable. Then, for example, minus plus, it means that we are using the cash to buy the land, which causes the cash to decrease and land to increase, mean cash decreases whereas the asset in the form of land increases. And for plus minus, this could be that if you are getting the cash back from the account receivables, so this means that your cash increases whereas account receivables decreases. But this is inconsistent terminology. Therefore, it is easy to get something wrong and be completely unaware that something has gone miss. On the other hand, the debit-credit system has internal consistency. For example, if one attempts to describe the effect of transaction in debit and credit form, it can be readily apparent that something is wrong when debit do not equals the credits. So, debit and credit rules are built upon inherently logical structures. So, moving towards the debit and credit rules. As shown at left, assets, expense, and dividend account each follow the same set of debit-credit rule. Debits increases these accounts and credit decreases these accounts. These accounts normally carry a debit balance. To aid recall, we can rely on a mnemonic, that is debt. Means debits increases expenses, assets, and dividend. Whereas on the right side, liability, revenue, and equity accounts each follow rules that are opposite to the debit rule. Credits increases liabilities, revenues, and equity, while debit result in decrease. These accounts normally carry a credit balance. To aid recall, we can form a mnemonic, that is relic. Means revenue, equity, and liabilities are increased with credits. So remember, for debit, we have a mnemonic, that is debt, and for credit rule, we have a mnemonic, that is relic. After discussing the basic terminology that will help us in double entry system, let's discuss the double entry system. It is an accounting system that is based on principles of duality, which means that every economic event has two aspects: effort and reward or sacrifice. And the another aspect is benefit, source, or use that offset or balance each other. For example, you pay cash to purchase supplies. For this, the cash you paid is equal to your efforts, your sacrifice, or your resource. So, double entry system. Every transaction must be recorded with at least one debit and one credit, and the total amount of debit must equal to the total amount of credits. Accounts are the basic storage units for accounting data and are used to accumulate amount from similar transactions, as we have discussed previously. So, moving towards the T account. T account are called T accounts because it has a resemblance with the letter T. It is used to analyze transactions. There are three parts of T account: a title, which identifies the assets, liability, or stockholders' equity account. Second, a left side, which is called the debit side, and the right side, which is called the credit side. As you can see, in account we can name as purchases, or could be inventory or anything, whereas on left side you should have a debit side, and on right side this is your credit side. The T account illustrated. This is an example of T account, that is T account for cash. So this is your footings and the last is your balance. Working totals are called as footing, means there is separate total for the debit side and separate total for the credit side, that is known as footings. Whereas balance or account balance is basically the difference in dollars or rupees between the total debit footing and the total credit footing. Means your balance is equal to debit footing minus credit footing. So for the rules of debit entry accounting, it is same as we have discussed the accounting equation, that is asset is equal to liability plus equity. So every transaction affects at least two accounts. Just like the mnemonic we have discussed previously, that means that for debit it is debt and for credit we have to follow relic. So debit assets accounts to increase them, whereas credit assets accounts to decrease them. Credit liabilities and stockholders' equity accounts to increase them, and debit liabilities and stockholders' equity accounts to decrease them. Next rule is total debit must equal total credits. Dividends and expenses are deductions from the stockholders' equity. Thus, transaction that increases dividends or expenses decrease stockholders' equity. Normal balance. Normal balance of an account is its usual balance and is the side, debit or credit, that increases the account. Normal balance for assets, the dividends and expense account. On the side, normal balance for liability, common stock, revenue and retained earning accounts is on the credit side. Normal account balance of major account categories is shown in the figure. Stockholders' equity accounts. Stockholders' equity account represent the legal claims of stockholder to the asset of a corporation or company. By the law, investment by a stockholder and dividends must be separate from the revenue and expenses for both income tax purposes and financial reporting purposes. Relationships of stockholders' equity account is shown in the figure, means common stock, retained earnings, dividend accounts, revenue accounts, and expense accounts are its component. Effects of dividends, revenues, and expenses on stockholders' equity. The formula suggests that stockholders' equity is equal to common stock plus retained earnings minus dividends plus revenue minus expenses. So, dividends and expenses decreases stockholders' equity because they are having negative signs. So any transaction that increases dividends or expenses, that decreases stockholders' equity, whereas revenue increases stockholders' equity because it has a positive sign. So transactions that increases revenues increase stockholders' equity. Let's move towards a review in a form of question. So, for example, on July 3rd, you rent an office and pay 2 months rent in advance of $3,200. You analyzed and came to know that there is an increase in asset, means you have paid the rent for the office. So, you have arranged a place for executing the operations. Whereas there is also a decrease in assets. For this means that you have paid the cash, that is your current assets, which is being decreased. After applying the rule, you came to know that debit increases the assets, means your prepaid rent will be debited, whereas the credits decrease your assets, means the cash has been decreased by $3,200, so it will be credited as seen. So for the accounts, your prepaid account for rent is debited because you paid in cash. So on 3rd July, cash will be debited with amount of $3,200, whereas your cash account will be credited on 3rd July with an assumption that you have paid the prepaid rent of $3,200. So that's all for now. Watch next for continuation of the topics. Subscribe The Perfectionist.